Welcome to our Series 6 study program. We are now going to review Chapter 2, Investment Companies. Hi, this is Colin Kleck. Nice to meet you guys, and we're going to jump into the investment company chapter. We need to know all about our different investment companies. However, the one investment company that I want you to really focus in on are open-end funds. This is the type of product that is tested heavily on the Series 6 and SIE exam. The Investment Company Act of 1940 defines investment companies. It defines three types of investment companies, and this act stipulates that investment companies must register with the SEC once the portfolio has 100 shareholders and $100,000 in assets under management. The fund must have no more than 40% of total assets invested in securities. For a mutual fund, the net worth to equity has to be 300%. For a closed-end fund, they cannot borrow from a bank. There are three types of investment company products, though those products are face amount certificate companies, which are now an obsolete product in the United States, unit investment trust, and management companies. So what are some of the benefits for investing in an investment company product? First off, it's a pooled account of securities, so there's diversification. With diversification, it's not putting all your eggs into one basket. If one company flunks, well, hopefully the others didn't, and your other eggs are okay, right? So we're also getting professional selection, professional management, and ease of ownership. I often tell people if you want ease of ownership, professional selection, diversification, you got to buy a mutual fund. All right, so what are some different types of investment companies? The first type of investment company is a face amount certificate. It was a forced saving plan that would invest in bonds, similar to a CD at a bank. It floated through this item early, and it was subject to a surrender penalty. Face amount certificates no longer exist, but you still need to know that they are one of the three types of investment companies. You just need to know that a face amount certificate is a type of investment company. Unit investment trusts are opened up underneath a trust indenture. That indenture will assign trustees and appoint a board of trustees to oversee the trust. A unit investment trust is created with a fixed portfolio. That simply means that the portfolio never changes securities. So a fixed portfolio for UITs, we can invest in stocks, bonds, money market instruments, etc. Fixed just means that the securities inside the portfolio will never change. A unit investment trust has a finite life or a fixed end date. It also has no manager, which means that it's very cost effective for the investor. The ownership for the investor is known as a share of beneficial interest, or an SBI. There are two types of management companies, open-end funds and closed-end funds. Management company characteristics. For an open-end fund, a prospectus is required on every new purchase because mutual funds are always in the primary market issuing new shares. Each purchase is considered a new share, and a prospectus is required during that initial public offering for a closed-end fund, whereas with open-end fund, shares are continuously offered by the fund. So if you want to buy into the fund will make new shares available for you, and when you get ready to sell that fund, they will redeem those shares from you. With a closed-end fund, once it's sold out of the primary market, it then trades in the secondary market based on supply and demand. The biggest difference between open-end and closed-end funds is simply something referred to as capitalization. So with capitalization, that refers to the investor's ownership of the fund portfolio. Anytime you invest in an open-end fund, regardless of what the fund invests in, your ownership is considered to be a common share of the fund. For a closed-end fund, they can capitalize through the issuance of common shares, preferred shares, and bonds by traditional corporations. So the pricing of a mutual fund may sell at the net asset value, or NAV, which refers to forward pricing. We also buy at the public offering price, or POP. For a closed-end fund, it trades, keyword trades, not redeemed, right? Based on supply and demand for the fund's share. Let's take a look at a diversified investment company according to the Investment Company Act of 1940. In order for a fund to be diversified, 75% or more of the total assets under management must meet the following two stipulations. A maximum of 5% invested in any one company, and a maximum of 10% ownership in another company's voting stock. If an investment company meets this 75% rule, then the other 25% can be invested however the investment advisor sees fit, if it meets the objectives of the fund, in order to maintain this diversified status. The first entity I want to mention in the fund structure is the board of directors, and they oversee all of the activities for all the other entities. The board of directors must have 40% of disinterested members, and that simply means the only affiliation that they have for the fund is being a board member. So if the other 60% was doing something wrong, hopefully this 40% would step up and say something. The other is the investment advisor, or that is the advisor for that fund portfolio. The investment advisor is always a firm. And I know that sometimes in the industry, we hear people call a registered representative an investment advisor. They're not really an investment advisor because they're not a firm. They're an investment advisor representative. A firm is an unnatural person. An investment advisor is a firm that meets something called the ABC rule. They give advice on securities as its business, and they're compensated for the advice given. Advice business compensation. A broker-dealer is different from an investment advisor. Both the investment advisor and the broker-dealer give advice on securities as their business. Where it's different is in the compensation. An investment advisor gets paid on giving the advice only, charges a fee for the advice, while a broker-dealer gets paid on the trade. The custodian is the safeguarder of the assets. Transfer agent is the processor. They're responsible for all the back-end office duties for affecting funds, trades, and all the back-end stuff. And finally, we have the fund sponsor, also known as the wholesaler, the distributor, or the underwriter. The job of the wholesaler is to market fund shares not only to broker-dealers, but also to the general public, right? The general investing public. So let's talk now about different types of funds. So we're going to do a little overview for different types of funds. We're doing this here remembering that in Chapter 7, we're going to start to apply this knowledge for suitability in customer accounts. The first category that we want to talk about is an equity fund. Equity funds primarily invest in stock, and they're traditionally for younger investors who are seeking capital appreciation and can assume higher risk. Capital appreciation means that we want to see the share price increase over time. So these are longer term investors. Different types of funds that are in the equity category include growth funds. These are funds for younger investors who want to, let's say, buy a share for $5 and in 20 years sell a share for $105. So they are aggressive. The value fund. A value fund, the portfolio manager at the investment advisor will take opportunities to find undervalued securities in the market. So for whatever reason, they might be at a low price or they may have not paid out a great dividend, but the outlook for the company looks really solid. There's no reason it shouldn't be performing and recover to the price. So value investors look for those undervalued securities that will probably retain and come back to their higher high points in the market. So for whatever reason, the price of the share is low. It's likely the analyst doesn't see any reason why that fund won't recover. So value funds invest in undervalued companies that are likely to recover to their actual perceived value. An index fund is a portfolio that invests in securities that mirror the benchmark index. So the main index fund that we see is the S&P 500 index fund. These funds are for younger investors who believes the market is efficient as is, and they don't want to pay a lot in fees. Because an index fund is passively managed, those management fees with the investment advisor are slightly lower than any other actively managed funds. A debt fund. These funds are going to invest primarily in debt or bonds, which we traditionally say debt funds are for older investors who are seeking some type of income. Some different types of debt funds include a U.S. government fund. This is for an older investor seeking income. However, they also are looking for a higher degree of safety on their principal of their money. So U.S. government funds are for those income investors who want a higher degree of safety. A municipal bond fund is suitable for investors who are in a high tax bracket. Because there's such a high tax bracket, municipal bonds can sometimes avoid federal taxes, but are subject to state and local taxes. If an investor is in a 28% or higher tax bracket, or if they're successful, we'll put them in a municipal bond fund for their federally tax-free interest income. A corporate bond is a moderately aggressive bond fund when compared to governments and municipals. These bonds can invest in corporate debts, so it's not backed by the full faith, credit, and taxing authority power of the United States government. So a corporate bond fund, even though a corporate bond fund is investment grade, it still carries more risk than the U.S. government fund. Why? Because corporations can go bankrupt. So what about money market funds? Well, money market funds are for investors who are seeking capital preservation and or liquidity. So basically, our investors need the money soon. Our two main types are traditional money market funds that invest in short-term debt such as commercial paper, T-bills, etc. A tax-free money market fund invests in short-term municipal debt, for example, like a revenue anticipation note. With a tax-free money market fund, this is suitable for an investor seeking capital preservation or liquidity. But what? They're also in a high tax bracket or deemed being successful. For a fund investing in securities outside of the United States, the different types of foreign funds include foreign international funds, global funds, and geographical funds. An international fund will slowly invest in common stock issued outside of the United States. So they are aggressive because they're investing in that common stock. Anytime you're investing in a foreign fund, regardless what type, as an investor, you become susceptible to currency or exchange rate risk. That is foreign exchange risk, Forex, right? That is the exchange between the US dollar and the foreign currency. That relationship is inverse. So if the US dollar is going up, foreign currency related to the US dollar is going down. So JPY versus USD, or USD Great British Pound versus JPY Japanese Yen. So these different currencies outside the United States could relate to the different exchange rate of the currencies and value. Between the US dollar and the foreign currency, that relationship is inverse, often referred to as pips or percentages and points. When the US dollar goes up, the foreign currency is going down in value. If USD is going up, Great British Pound's going down on that pair. A global fund will invest in common stock issued outside the US, but it can also invest in securities and stuff issued inside the United States. So even though we have that opportunity, remember that global funds are still susceptible to the exchange rate risk. The most aggressive foreign fund is a geographic fund. You might also see these referred to as regional or country-specific funds. When it comes to a geographic fund, these funds are the most aggressive out of all of our foreign funds because they invest in a specific region or a specific country. Finally, let's finish up by talking about blended and exchange-traded funds. A blended fund invests in stocks and bonds. It's a blend, a balanced fund first. A balanced fund can invest in stocks and or bonds, and It will retain a fixed percentage of each type of security as stipulated in the prospectus. Most balanced funds have 50% invested in stock and 50% invested in debt. It's balanced. An asset allocation fund is not stuck to that balance. So with an asset allocation fund, you can invest in also stocks or bonds, but it may have 70% in equities for younger investors who are high, or a higher rating in debt for older investors. So asset allocations are a bit more flexible. Finally, a target date fund, and this is a type of asset allocation fund, and this is the type of fund that we see in retirement plans at work, 401ks. So target date at retirement, let's say, is 2035 for a 40-year-old worker, 50-year-old worker. So these target date workers are a really great way for people to save for retirement without having to do a whole lot of work, because all you got to do is keep your job. The portfolio takes care of that work for you, right? So when our target date is new and the investor are young, the portfolio will be highly concentrated into stocks. Then, as stipulated period of time goes by, it will start shifting the portfolio over to more bond or income producing assets. So by the time that 2035 comes around and the person's ready to retire, what happens is that the higher rating is now in debt, not equity. You didn't have to do anything, but the investment advisor took care of that for you on your behalf, having the portfolio for a 401k. An exchange traded fund, or an ETF, is considered to be an open-end fund, but it trades on the stock exchange like a closed-end fund. Mutual fund shareholders became frustrated with the fact that you had to have forward pricing, and if there was a huge market announcement that you wanted to get out of your share price at that specific price at that exact point in the time and day, well, that's not possible with mutual funds. And the reason for that is that they go off a method called forward pricing. It's priced at the end of the business day, calculated at the next computed net asset value of the fund. So it allowed, exchange traded funds allowed investors, they're basically tradable versions of mutual funds. So if something happened at big event that, some, giant news research report comes out on this ABC company has devastating data leak scandal, well, maybe the market price is about to drop and you want to get out of your security. Well, that's possible with an exchange traded fund, because it's a tradable version of mutual funds with a more flexible schedule. So you can get out of the market more quickly, perhaps, than another type of mutual fund, right, where it's going to go off of forward pricing and redeem at the next computed net asset value, which is going to be at the end of the day. So the exchange traded fund is a tradable version of mutual funds. ETFs are considered to be open-end funds, but it trades on the stock exchange like a closed-end fund. Most ETFs benchmark against an index, and the most popular ETF that we see in the market today is called SPDR, and it's an S&P 500. When it comes to reinvesting dividends in capital gains, we want to remember the tax implications. So dividends and capital gains distributions are going to be taxable in the year that they are received. This includes when the investor reinvests those dividends and capital gains. Reinvested dividends and capital gains are not subject to sales charges. They are subject to taxation. A 12b-1 fee is used to recoup the costs of distribution and marketing the mutual fund by the fund itself instead of the broker-dealer. The board of directors will get a report on the 12b-1 fee every quarter. The 12b-1 fee for investors is detailed in the fund's prospectus. Any changes to the 12b-1 fee requires a 60-day notice. When a 12b-1 fee is brand new, in order to adopt a 12b-1 plan, a majority vote of the shares along with the majority vote of the disinterested board members and majority vote of the total board members is needed. To end or kill a 12b-1 plan, it requires the majority vote of the disinterested board members and or a majority vote of the shares. Dollar cost averaging occurs when an investor invests a set amount over a reoccurring basis at regular intervals. So let's say you're paying $50 every single month on the 15th. They're going to be able to buy more shares when the price is low and buy less shares when the price is high. So let's take a look at an example of dollar cost averaging. Our investor invests $100 every month, and the public offer price is going to vary based on what the fund's criteria is. So they'll also show us the number of shares that they buy for every single month. The thing that you want to remember is that the average cost is always lower than the average price per share when utilizing dollar cost averaging. To find the average price, you take the total public offer prices and expenses, that'd be 105 divided by the number of months, that's 4. Instead, we look at the cost basis. This is the formula that we might have to calculate. We take the total dollars invested, which is 400, and divide it by the total number of shares that's acquired, which is 21, in order to get our average cost per share. So $400, and divide that by the total number of shares that were acquired in 21. This gives this a dollar cost average of $19.05, which mutual fund shares, record keeping is done by the fund and sent to shareholders. Automatic reinvestment at the NAV is automatically assumed, and our mutual fund shares can be used as collateral against the loan as long as we've held it for at least 30 days. When an investor ends up redeeming out of their fund, they redeem at the net asset value, or NAV. The maximum redemption fee is 2%, and the redemption fee sales charge cannot exceed 8.5% total, and the fund must send its redemption proceeds to investors within 7 calendar days of that redemption request, assuming that it's all in good faith and good terms. Right, so an investor can also set up withdrawal plans. A withdrawal plan out of a fund requires that a minimum balance is maintained. A withdrawal plan is a set dollar amount, and it can deplete principal over time. The different types of systematic withdrawal plans, or SWPs, you can set up are based on fixed dollars, fixed share, fixed percentage out of the fund, or a fixed time period. You can also set up systematic purchase plans, which is how you utilize dollar cost averaging. And finally, we're going to take a look at mutual fund communication. When analyzing a mutual fund prospectus, the fund prospectus is going to tell us if that fund is open-end or closed-end. Is it a diversified or non-diversified mutual fund? What is the fund's objective? So remember, this is usually a very broad objective. The computation of the NAV and POP, descriptions of the sales charge, management fees, and other fees associated with the portfolio. It will also give an explanation of breakpoints, rights of accumulation, letters of intent, any type of withdrawal plans allowable, and exchanges made within the same complex or mutual fund family. So when we're analyzing mutual funds and looking at the prospectus, they're going to give us the fees and expenses over the past 1, 3, 5, and 10 years. This is going to be based on the $10,000 investment. The maximum sales charge, maintenance fees and redemption fees, along with management fees, 12b-1 fees, and other operating expenses. We also take a look at the expense ratio. It's the annual operating expenses divided by the net assets, or the average net assets. Funds like to keep their expense ratio around 1%, relatively low. Expense ratio is all of the fees for the fund and none of the charges, so it does not include sales charge. What is included in the expense ratio are different administrative fees. The management fee for the investment advisor, which is the largest expense for any fund, the investment advisor fee, and 12b-1 fees. Other reports that we look at are the semi-annual financial reports, and these reports detail the investments, the detailed income and expense ratio, assets and liabilities, along with changes in net assets. Customers receive this report semi-annually, and the SEC receives the report on an annual basis. Annual reports must be audited, while semi-annual reports are not audited. Let's talk about mutual fund taxation. Mutual fund dividends, the net investment income, or NII, mutual fund dividends are considered ordinary income and they are subject to taxation. The dividend yield is the annual dividend per share divided by the net asset value. A mutual fund's dividend yield does not include long-term capital gains. The cost basis and sale proceeds of a fund, The cost basis is the total purchase price for a fund with after-tax dollars. The sale proceeds are what the investor receives when they sell their shares. If the cost basis is more than the sale proceeds, the investor realizes a capital gain. If the sale proceeds are higher than the cost basis, the investor realizes a capital loss. The dividend dates for a mutual fund, the declaration date is the date that the fund declares the dividend. The ex-dividend date is the date that the fund trades without the dividend attached. It is 1 business day before the record date for stocks. It's not important on this test because for a mutual fund, what you'll be tested on is the ex-dividend date for a fund versus a stock. The ex-dividend date for a fund is 1 business day after the record date. Stocks are DERP, funds are DREP. The record date is the date that we have to own the fund by in order to get the dividend, and the payable day is the date that they actually write the check. And FINRA says that we cannot sell dividends, meaning we cannot entice a customer with a pending dividend in order to get them to buy or entice them to buy a stock. All we're doing by selling dividends is by giving the investor immediate tax liability, right, which would disregard what happened from paying the dividend. So selling dividends is a no-no. Dividend taxation, qualified dividends come from corporate dividends and are taxed at 15%. Non-qualified dividends come from money market and bond funds, taxed at ordinary income rates. There are 2 types of capital gains. A capital gain distribution. This is done by the fund based on the fund's activity. We always assume it's taxable to the investor at 15%, regardless of the investor's holding period. With a capital gain event, know that the investor is in charge. The investor sold their fund for a profit. Now, we care about the investor's holding period to determine whether the gain is long-term or short-term. A short-term capital gain is a holding period of 12 months or less, and it's taxed at ordinary income rates. Long-term capital gains have a holding period of 12 months and 1 day or longer, and it's 15% for most investors. For the very wealthy, it's 20%. What about a capital loss? If the investor has a net capital loss, then the IRS stipulates that the investor can use $3,000 maximum as a deduction against their ordinary income in that year. The rest of the investor's loss will carry forward until it's all used. A mutual fund exchange means you're going from one mutual fund family to another mutual fund in that same family. It's always a taxable event, seen a withdrawal from one fund and a new purchase in the new fund. The purchase into the new fund will establish a new cost basis for the investor. So let's wrap up investment companies by going over subchapter M, which is a conduit tax treatment theory or a pipeline theory. If your fund is a regulated investment company, it has at least 90% of the net investment income, or NII, that passes over to shareholders in order to qualify. So there is a difference between registered and regulated. Registered means that the security registered with the SEC in accordance with the Securities Act of 1933, the first act over the new issue IPO market, right, and the Investment Company Act of 1940. Regulated means that your fund follows subchapter M. It has been excellent to go through chapter 2. Now I want you to go over to millionairesintraining.com and get into the program. Learn about investment companies and take your practice questions. Read your chapter explanations and question explanations and review them clearly so you can learn this information. Improve your scores by taking multiple exams until you can better 80, 90, and 100% our tests on Millionaires in Training. You have done so well moving forward with our SIE and our Series 6 exam. Congratulate yourself, warrior, because this is your road to registration. Never let this license expire once you get this. And stay tuned for great securities content because we will be creating millionaires at millionairesintraining.com. Catch the wave and make the game, warrior. It's time to become a part of an unparalleled movement, changing lives and focusing on benefiting people's financial futures.